If the Federal Reserve continues on this path, production and employment will be weaker in the coming year.
The Fed is trying to cure an illness, and that illness is high inflation. And what the Fed is doing is using more policy tightening. And that tool is a very blunt tool because what it does is it brings down aggregate demand, and it basically has a long lead time, meaning that when the Fed raises rates, the actual full impact of those things take about 12 months.
If the Federal Reserve continues on this path as harshly as it has, production and employment will be weaker in the coming year. They're waiting for inflation to slow when it's a lagging indicator. And this is really the crux of the policy risk to the economy.
We think that the housing market in particular will be a good indicator of whether the Fed is deaf and continues to raise rates in spite of the data that they're going to see or not.
This is really important to think about what are the downstream effects of having double-digit sales declines and the beginning of a construction decline, while we still have unsatisfied demand. But what's happening to housing-related merchandise, parts of the really strong part of consumer spending in the last 2 years, and it's already falling. You take a look at furniture, housing, durables, new home sales, all of it is going to fall more.
So effectively, what's happening here is two sides of a coin. You've got higher mortgage rates driving housing demand lower. You've got higher mortgage rates driving rent higher, which is part of the consumer price index, and both higher rent and lower purchases of homes both negatively impact the sale of furnishings and durable goods for the home. And so again, you can see the multiplying effects of what the Fed has already done in raising rates and telling us what it was going to do. One of the things that Stephen and I have to do in our job, and you have to do as an investor, is to actually invest counter to how you feel. If stock market is down 25 or even 30%, it's going to feel awful. And yet that's when you need to buy it. Now that the bond market is down 13 or 13.5%, you should be buying it for the exact same reasons, because it feels awful. You shouldn't have a lot of cash. Because why would you own an asset today that is going to be worth 90 cents in 18 months when you can actually invest today in municipal bonds or investment grade bonds or other securities, which allow you to earn an amount of interest that's equivalent to the inflation rate that we expect over that next 18 months? We will rotate portfolios into riskier parts of the market when we have clarity about the direction of Powell's Fed.
There is going to be a global slowdown. Our forecasts for global growth are way below trend, consistent with what we could call a global recession. Contrasting the regions is really important. China looks like an economy that is at a trough and likely to rebound. Europe to us looks negative. We're underweight stocks and bonds in Europe.
Ultimately, the resilience and strength of this economy, the need for innovation and technology is unabated. And what we have to go through is a period of difficulty because we do expect the war, unfortunately, to drag on for a while. We do expect that China's recovery is going to take longer because of the policies they've chosen associated with COVID. And we do think that the Fed policies are potential headwinds. But all of those things, God willing, will end. And that will leave us in a situation where we can look forward to a recovery in 2024 and 2025, which the markets will anticipate even at the end of this year or the beginning of next.